Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Ekta Batra. Good afternoon, Ekta. Well, we continue to consolidate at the 25,900 mark. Second consecutive day of selling for our own markets as well. Midcaps, they are underperforming, and advance decline ratio absolutely in favor of declines today.
Hi Sonal, yes absolutely. Actually the texture of the market is not looking good at all. We have the Nifty which is below 26,000 as we speak at the low point of the day. For the Midcap index also it's lost around 1% and there's a clear underperformance which is coming through in terms of the broader markets. And as you can see, the advance decline ratio is on the declining side, significantly on the declining side at this point in time. But nonetheless, let's take you through all of the top stories that we're tracking and we'll get to all of the discussions that we have lined up as well. Stocks come under pressure as the rupee slips with the declines outpacing advances. Metals, IT, financials and energy are big drags while telecom and consumer durables eke out some gains.
The rupee breaches 91 to a dollar despite a lower than expected trade deficit in November as unhedged importers rush to buy dollars. A delay in concluding a trade deal with US and continued foreign investor selling continue to be a drag.
Motilal Oswal issues a buy rating on Arvind Fashions with a target of 725 rupees per share. The stock price is 3%.
All right, those are top headlines that we are tracking. The move in the rupee and in the mid-cap segment continues to be on our radar. The small caps too are seeing a big fall today, 1% lower on that one. And the rupee has been steady at the 25,890 mark since the time we started our trade. FMCG though is a bright spot today, Ekta. That one is in the green as we speak.
Yes, absolutely. The FMCG stocks are managing to hold up a little bit in today's trading session. Maybe some amount of buying coming through. Tata Consumer Products, for example, is up around 1% at this point. Trent is not doing too badly. Asian Paints, so a couple of these consumer plays seem to be standing out at this point. But let's get to Hormuz. This is our mid-cap movers segment. We're going to kick off the show with that. We have Hormuz to take us through all of the broader market stocks which are buzzing around in today's trade. Hormuz.
It does not look good for either the Nifty or the broader markets for that matter, and you're seeing selling across the board, barring the FMCG stocks, of course. Even they too have come off slightly from the highs of the day. But you start off with some of the losers in the broader markets and you would see that there is no particular segment that is seeing those kind of losses. Man Industries is down 5.5%. Stallion India, one of the best performing IPOs of the year, continues to witness some profit booking. Embassy Developments too down 5% in today's session. Metals as a segment has been sulking. They did fairly well last week, but they are now witnessing some profit booking at higher levels, be it SAIL, NMDC, JSPL, all of them seeing losses of anywhere between 2 to 3% in today's trading session. It is also not good going for a lot of the QSR names, and all of these three names on the list here, be it Jubilant Foods, be it Devyani or be it Sapphire Foods, all of them are trading at a 52-week low in today's trading session. Losses of anywhere between 1.5% to 3.5%. Stocks that are bucking the trend, if you would call it that, on strong volumes as well. Praj was up yesterday, up today as well. Kirloskar Oils doing well. 5-Star Business Finance doing well. All of them have come off the highs of the day, but somehow managing to hold on to those gains on significant volumes. And a pocket that has been bucking the trend all through the morning has been the fertilizer names. The fact does not have enough free float in the market, but still up 5%. Chambal Fertilizers is doing well for itself, and RCF has come off slightly from the highs, still holding on to gains of 1.5%.
All right, take that point. Some of those stocks in the green in an otherwise weak market. Thank you so much, Hormuz, for joining us with all those details. Let's now welcome Shrikant Chauhan from Kotak Securities for a technical check. Shrikant, good afternoon. Thank you so much for joining in. What do you make of the moves that we are seeing on the market today? Any important levels that we should be watching out for?
Good afternoon, Ekta. Good afternoon, Sunil. For Nifty, it has remained stable for the last 3 hours. It is not crossing the level of 25,900. There, if we see, the open interest is increasing heavily. And on the downside, 25,850 is going to act as major support, as there also we are seeing good amount of put writing. So broadly, I am of the view that till the market is not crossing 25,925 during the day, we can expect range bound sort of activity, and maybe the market may close around 25,900 only. But if it manages to cross the level of 25,925, then we can expect furthermore short covering, and may the market close around 26,000 sort of levels. But today it's a day of event. a lot of things are going to come in the US markets, I mean to say on the data side. And because of that, maybe the market is remaining in the range. But ideal pattern is clearly indicating us that at important levels, the market is finding support. And whenever there is slight improvement in the market, we are seeing upward activity. So broadly, I am bullish on the market and strategy should be to buy on dips.
Okay, strategy should be buy on dips. But just Shrikant wanted to understand that I'm sure you're getting a lot of queries from your clients about the rupee depreciation and, how exactly could you probably play the markets on account of that, or maybe that, how exactly should you probably approach the markets in the context of this rapid rupee depreciation that we've seen. So just give us a sense in terms of what you're recommending and advising.
See, for the time being, we are consistently keeping a close watch on the overall performance of the rupee. But the way it is depreciating, it is little bit concerning. It has crossed all its important level. I'm going to say it is falling on a regular basis. And now the next level to watch out for would be maybe 91.50, 92. Ideally, we are like asking our clients to look for adding those particular companies which are like more defensive, like FMCG, pharma, or even we can say IT companies. For the time being, we are not keeping any specific view on the overall trend of the rupee. But yes, the way it has depreciated, the possibility is that it is heading little lower from current levels.
All right, Shrikant, thank you so much for joining in with your thoughts and the market outlook as well in terms of charts. With that, we'll slip into a short break. When we come back, we will get you a special discussion on the Insurance Amendment Bill on the other side with our experts. Stay tuned for that.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Let's get talking about the big development which has taken place. The Insurance Laws Amendment Bill, which received the Union Cabinet's nod on Friday, has been introduced in the Lok Sabha today. This allows 100% FDI in the sector and much more. We have with us Thomas Devasya, who's the former member of non-life insurance at IRDAI, and Nilesh Sathe, who's the former member at IRDAI, to discuss more on this. Gentlemen, thank you very much for joining in and talking to us. Mr. Sathe, I'm going to start by talking to you about the FDI in insurance, which has now been, increased to 74%. There wasn't much of a change which took place when, the limit went from 49 to 74%. But now that it's risen to 100%, what is your sense in terms of the incremental foreign inflows in terms of deals that we could expect?
No, immediately, I don't expect incremental flows so soon, because all said and done, after the Act is amended, the regulations will have to be framed by IRDA. That will take about 6 months, because 6 months is the time limit which is prescribed for IRDA to frame regulations. So within 6 months, it should be done. And only thereafter, the things will be clear. Second is when it has been increased from 49 to 74% 5 years before. During these 5 years, not many foreign insurance companies have entered the market. Actually, not much of foreign inflow in capital has come. But again, that does not mean that with 100% it will not come. Actually, it has not come for many reasons. One is Indian partner was a must earlier. With 100%, now they don't have to search for Indian partner. They can start their own business at 100% FDI. So this is one big advantage. And as a result of which, there will be many insurance companies which have operations in many jurisdictions all over the world. They may think of tapping Indian market because India is a growing economy. So they would definitely like to tap market here. Penetration is low. The scope is more, the per capita income is going up. Hence, I expect in the next 5 to 7 years, there will be sizable amount of inflow of FDI into insurance. And at least 5 to 10 insurance companies should start their operations on 100% FDI.
Okay, all right. So you will see some more interest coming in from foreign companies now that the limit has been raised to 100%. But as you pointed out, it will take around 6 months for the regulator to formulate those rules and put all of this into execution as well. Take that point. Mr. Devasya, the other big point has been the capping of commissions that has come by for platforms. Do you think this is a structural change which could impact some of the other players, platform companies, something like a PB Fintech that is listed as well? But again, this is also a business that they have around insurance, right? It'll be positive for insurers, but do you think it's a big structural negative for some of the players in the industry?
Depending on what's the business mix. Okay, but capping of commissions is very much warranted in the entire distribution system because ultimately it's a cost to the consumer. And we cannot afford to see insurance premiums rising, especially in a context of very low penetration, very low disposable incomes with regard to the retail sector or the household sector. And also for the purposes of, the concerns that we have on global competitiveness of, manufacturing sector. So limits have to come in. While limits have been, released in a manner that there was only a global limit, there was no individual policy or line of product limit. So it's necessary, it will affect, but it's overall for the health of the industry.
Okay. Well, Mr. Sathi, I just wanted to actually put that question across to you with regards to the commissions as well. What is your sense in terms of the fact that there is this capping of commissions when it comes to platform companies? And what do you think would probably be the impact, say, if you had to discuss this 6 to 12 months from here on?
Yeah, again, in this also, there will be 6 months for coming out with regulations. This is number one. Second is, it is not that in the past, there was no ceiling on what commission rate you can pay on a variety of products. It was subsumed in expense of management regulations for reasons best known to IRDA. But even at that point of time, I was of a view that that should not have been done because the capping of commission it ensures that nobody can exceed those limits. So why it was done, I don't know. But good, at least now there will be a capping. And probably now it may be product-wise capping, like for term insurance, it may be at 15%, 10%, whatever IRDA deems fit. Or for ULIPs, it may be 15%. For term, it may be 20%, whatever it is. But it is good that the capping will be there for commission. That will also help IRDA to check and control whether somebody is violating those. Because under any pretext or under any some different name, if at all the companies are paying to distributors something beyond what is prescribed, now that can be checked. And it is very good because that will bring the cost also down, manufacturing cost of product also down, and it will help the customers ultimately.
Right.
So it's a good move,
Okay.
positive move in my opinion. To what extent the distributors may get impacted, time will tell, number one. But again, to what extent they should be given commission is also one area which was very vague in the past. Now it is good that it has been proposed.
Mr. Sathe, so it would ultimately, as you both pointed out, it would bring down the cost of product or cost of insurance down for consumers ultimately, and that will help penetrate the market a lot more, and it will be good for the consumers at the end of the day. Last question before we let you go, Mr. Devasya, I wanted to understand if you think government missed out on the opportunity of bringing composite insurance license. Do you think if that had come, it could have actually helped broaden the pie a lot more?
Oh, no, I doubt so much. See, composite insurers is basically, I believe it's more on the conceptual level because finally there are very clear delineations with regard to how financial resources are managed, how governance happens. So composite is not so critical with regard to the expansion of the market. Yes, it will enable certain entities to have economies of scale by pulling in certain functions at a common level, while driving distribution also uniformly. But given the market that is open here, awaiting services, I believe composite insurers as such is not a game changer or something that will immediately trigger exponential growth. I believe the focus of the bill here is to address whatever is immediately required. And I can see that they have done a lot of cleanup in the legislation, including clarifying definitions with regard to intermediaries. And they've also kept open any other line of business that may be prescribed in the future. And they've created general insurance, health insurance, reinsurance, and they've added this point additionally into the amendments.
All right, gentlemen, we leave it on that note. Thanks very much for joining in and giving us all of your perspective with regards to the insurance bill. We need to actually turn our focus back to the markets because there's a little bit of a recovery which has taken place from the day's low. The day's low, remember, stood at around 25,870. So we are 50 points off that day's low at around 25,920. So let's see whether there's any kind of formidable recovery that takes place. We'll take a short break, but up next we'll get you a lot more on the markets, a lot of stocks in focus. Stay tuned.
Welcome back. You're still tuned in a Midcap radar. We are above the 25,900 mark. A wee bit of recovery, but we'll see whether that sustains or not. For now, the midcaps continue to see an underperformance, but the Nifty Auto Index, that has turned into the green. So we'll watch out for the recovery that's taking place in the markets. But we'll take your leave now. Stay tuned. A special discussion on rupee when we return. That's the big story that we are tracking today.